Joining us right now to talk about today's data and whether the economy is really as strong as the stock market would have you believe is Glenn Hubbard. He is former Council of Economic Advisors chairman and a professor at Columbia Business School. Glenn, we've watched this huge V-shaped recovery in the stock market, at least. The economy not improving at the same pace, but the stock market's always pretty forward-looking. So what are you seeing right now, and what are you kind of thinking where we'll be? I know it's impossible to guess, but let's say a month or 2 months from now.
Well, in terms of the stock market, of course, the stock market's not the same thing as the economy. It's very forward-looking, and it's picking up, obviously, the chance of a recovery, but also very low levels of interest rates and discount rates, a lot of Fed action, and the importance of names that have a lot of market power in the current environment. So it's not that the stock market's wrong. It's just not the same as the economy. In the economy, I agree the initial claims numbers, which are coming in right around what economists had forecast, are relatively good news. Continuing claims are still high. To me, the question going forward, and I certainly hope the ADP number is right, is how quickly the labor market does heal. And that's going to be a lot about how we help small businesses, how we help people retrain and get new jobs. That's what's worrying me.
That's a big question. We had Rick Scott, the senator, on earlier this week from Florida, and his point was we've already spent $1 trillion. There is definitely some fatigue that's setting in among legislators, at least some legislators in Washington, thinking, what more can we possibly do? We've already spent this much money. What would you be advocating at this point as somebody who has been in Washington and who has worked around policy and has looked at some of these initiatives? When you talk about job training or trying to help small businesses, what specifically needs to be done?
Well, the first thing is to get the rest of the CARES Act right. You know, as part of the CARES Act, the Congress appropriated $454 billion to the Fed, part of which would be used to stand up a Main Street lending facility. The Fed has not moved with dispatch on that, and the Treasury Department is really coming up with design limitations that I fear are going to make it less effective. That money's there. It's ready to backstop a Main Street facility, and the Fed could do it. Another big issue is community colleges in the country. We could have a massive federal support for community colleges that costs a fraction of what we've been spending elsewhere. So I think if we're smart about it, make the CARES Act work, help community colleges, we'll make a lot of progress, and we're going to need to.
What are the limitations you're talking about, design limitations coming from the Treasury on how those funds are used? Which ones do you think are inappropriate?
Well, I think in terms of the Main Street facility, part of the issue is making banks feel comfortable making these loans without a lot of underwriting penalties for borrowers, making sure there's a long enough maturity and a low enough interest rate that make it attractive. You're trying to really simulate patient capital for these businesses so they can get back on their feet. I fear the program as it's designed will have no lenders and no borrowers. That means it won't lose any money. Also means it won't be very effective.
Because the banks aren't going to want to make these loans? They'll be too concerned about the penalties or the implications of what comes?
Correct. And banks aren't unreasonable to fear that. The government has in the past gone after banks and retraded policy initiatives. I think the Fed is being very careful here, but the Treasury's focused on not losing money or losing very little money. It's going to make this program less effective. If we don't get small and mid-sized firms back on their feet quickly, we run the risk of a lot of failures and further job loss. That's the second wave that Steve mentioned. And, you know, small businesses churn all the time, of course, but they don't just pop up overnight. And if we want the labor market to heal, we got to fix this.
Glenn, we had Jason Furman with us a little earlier this morning, another former Council of Economic Advisors chairman. His point was he's concerned about the state and local governments at this point, that if they don't get additional support, that you are going to see massive layoffs that outdo the layoffs that we saw from state and local governments back in 2008 and 2009. He talked about how the drag over 5 years added up to something like 3 percentage points, 0.6 of a percentage point for every year over 5 years. Do you have concerns about that too?
I do, and I think the drag may even be a little bit higher if you focus on the estimates that Mark Zandi has put out. To me, there's two critical reasons for aid to states right now. One is public health infrastructure. The pandemics don't live within state boundaries. This is as clear a reason as I can imagine for more assistance. The second is just the logic that was in the CARES Act to support private businesses so that there wouldn't be a lot of layoffs. Same logic for the states. And I think there are ways to structure block grants to do that, changes in Medicaid matches, other funds. The National Governors Association has a proposal to do this. I think it's very, very important, or again, we're going to get the second wave of lower aggregate